And because of that, because we had the wedge top, that increased the chance that there might be sellers above the high of July the 10th. Overall, we're far from the moving average, and I think the odds are we're probably going to go sideways and get to the moving average. So in one of two ways, we can go straight down to the moving average, or we can drag the moving average up. Today's a strong enough surprise, it'll probably get at least a small second leg down. So coming into today, we gapped up on the open, and it was a strong enough gap that the odds favored a second leg. However, because of the daily chart and what we just talked about, that actually increased the chances that there would be sellers above, that there might be sellers on the open. And then bar one being a reversal bar closing on its low, that's a strong enough bar that it increases the chances that the market is probably going to go a little bit lower. Two consecutive bear bars, 1 and 2, strong enough that we'll probably get at least a small second leg down, and therefore we have a possible bear trend from the open. Three consecutive bear bars, 1, 2, 3, probably sellers above 3 and at least a small second leg down. And then 4 outside down, good for the bears, probably going to go at least a little bit lower. 5, a doji in an inside bar, probably not a great buy above because of the 4 consecutive bear bars. That makes me think there's probably sellers above, and we're probably going to go at least sideways. 6, bear breakout, closing on its low, good for the bears. Strong enough surprise that I suspect strong enough surprise down from 1 to 6 that I suspect whatever reversal up we get will probably be minor. 7, doji, but probably doji, increased risk of buyers at the moving average, but a tight bear channel increased the risk of sellers above. And then a bull bar, 8, good for the bulls, but probably a minor reversal if we do get the reversal up. 9, breakout of the bull trend, good for the bulls. What about buying consecutive bull bars? I would not. 8 and 9, probably strong enough that we may get a small second leg up and hesitate, but really, not ideal after this much selling pressure. 10, doji, the market rallied, pulled back on 10 and rallied. That increases the chance that we may find sellers up here. And then 11, a bear bar, good for the bears, probably going to go at least a little bit lower. 12, bear breakout below the bear flag, strong enough breakout, probably going to go lower. And then 13, we have a doji, sold off, rallied. That's a sign of profit taking, but the sell off from the 10 high to the 13 low is strong enough that I suspect there's probably sellers above 13. And then 14, bear inside bar, good for the bears, probably going at least a little bit lower, but we may end up pulling back first. And then 15, bear breakout below the inside bar, but not a great bar to buy above. So if we do get a reversal up, it's probably minor. And then 16, bull bar, good for the bulls, but a micro channel from the 10 high, probably sellers above. And then 17, a little bit of a surprise bear breakout, and now we have a parabolic wedge. 7, 15, 17, probably buyers somewhere below, and we're at the moving average, the 60-minute moving average. 18, consecutive bear bars, but late in a bear channel, probably going to get a bounce. And then 19, a bull bar, good for the bulls, probably going to get at least a small second leg up. And then 20 consecutive bull bars, but after 17 and 18, I suspect the upside is probably limited, which makes me think that I suspect the upside is limited, and that makes me think that we're probably going to go more sideways here rather than straight up. Targets for the bulls, test of the 16 high, most recent sell climax and most recent major lower high. 21, bear bar, good for the bears, probably buyers below. 22, doji, and I expect we'll probably get a bounce and a second leg after 19 and 20. 23, bull breakout at the moving average, good for the bulls. but probably a bad follow through and probably mostly sideways. 24, follow through buying for the bulls, but possible 2 legs up after a tight bear channel, increase the risk of sideways. Bear bar, 25, but after 3 consecutive bull bars and a 3-bar micro channel, 22, 23, 24, probably buyers below the 24 low and the 25 low. 26, doji, bad high 1, probably sellers above. And then 27, a bull breakout of the high 1, but a weak close. And then 28, 3 consecutive bull bars, 26, 27, 28. Good for the bulls. Bulls want a bull break out of the bear flag, 17 low to the 24 high and a measured move up. Bears will see a wedge bear flag and a wedge top, 20, 24, 28. And then 29, reversal down. Good for the bears. Probably going to get at least a small second leg down. And then 30, we broke below 29. However, we failed to form a strong entry bar. But 30 is actually a bad high 1, and that increases the chances of sellers above. And then 32, 31, bull bar, but not a strong buy above, so probably going to pull back and get a second leg down. And then 33, a little bit of surprise, good for the bears, may go a little bit lower. And then 33, bad reversal bar, weak buy above 33, increase the chances of sellers above and more sideways. 34, doji, probably buyers below and at least a bounce. 35, a small second leg up after 33, and then the pause on 34 and the second leg up 35. 36, bear bar, good for the bears, but I suspect more traders buying down here than selling. So it's a weak low 1 on 36. 37, we broke above and sold off. And arguably, we had a low 1 and the market rallied. And typically when you get a low 1, it's common for the market to rally and then it's common for the market to pull back on the low 1 and then try and get resumption. And it's possible 37 is trying to get resumption. The other problem is that the market probably needs to get down to the 18 low, which is a logical magnet for the bears. Bears sell the 18 close, scaling higher, and they end up making money back to the 18 close. 38, bear breakout, good for the bears. Not a good reversal bar for the bulls, and that's why it's good for the bears. And then 39, we have a bull reversal bar. Good for the bulls. I expect we're going to go ahead. It's good for the bulls. Reasonable for bulls to exit above 39. One moment here. Reasonable for the bulls to exit above 39. But even if they do, I suspect that the upside is probably minor without at least falling below 18 first. And then 40, not really what you want to see, but a bad low 1, so we may try and go higher. And you can see what happened with 41. We found buyers below 40, rallied, but found sellers in the upper third of 40, and then we sold off. 41, bear bar closing on its low, may go a little bit lower. And then 42, we broke to the downside. Strong enough surprise, probably at least second leg down. And we tried to get the reversal up 43, but then we got the low 1, 44. And we ultimately ended up going sideways, 44, 45. Inside bars increased the risk of a final flag, and we broke to the downside below 45 and 42 and reversed up 46. Always in bears, I think you get out below 46. Too much risk bulls will buy. And then we started to get the rally. And I mentioned that the first magnet was the test of the 40 high up here. 4 consecutive bull bars in a 4-bar bull micro channel, 46, 47, 48, 49. Strong enough rally that I expect will go at least a little bit higher and test up to the 40 high. And then 51, we got the reversal down. And we tried to break below 40, but we couldn't end up, we didn't quite get there. 51, reversal, but not enough. Probably not enough reversal after this many bars up, so probably buyers below. And then the bulls got the outside up, effectively going above the 40 high, 153. Outside up 53, good for the bulls. And then 54 follow through. Looks like we're going to go a little bit higher, maybe up to the 28 high. And the bulls started to get a tight bull channel. They started to get a lot of overlapping bars. And that increased the chance that we were going to start to go sideways soon. 60, possible wedge, but more or less a tight trading range. Better to do nothing. and then we broke below the tight trading range 62, and that's a little bit of a surprise, and therefore it's possible we get a small second leg down, and that's what happened with 63. 62, 63 consecutive bear bars, good for the bears, but the bears need more than just 2 bars. Bull bar 64, but not a good buy above, so probably sellers above. And then 65, bear breakout, good for the bears. We may end up going a little bit lower. The bears, they'll see it as a breakout below the bull flag. These bars right here. And we ended up getting follow through on 68 or 66. 67, 66 consecutive bear bars, strong enough that we may get a second leg down. In 67, we got a reversal, but not a strong enough reversal to undo the past 2 bear bars. Low one short on 69. Good for the bulls, not a good low one for the bears, and therefore probably buyers below, but enough of a surprise. 65, 66 that there might be sellers above the bar. 69, bull bar, not a great buy above, not a great sell below. And 70, outside up, good for the bulls, but after this many consecutive bear bars, it's possible that if we triggered the buy and start to go up, we could reverse down and form some variation of a low too. And that's what happened with the 71 low. 71, big bar, big risk for the bears, and a tail below the bar, not a good sell. And then we ended up getting follow through 72. Some bulls that bought the 71 low too, betting on a bad sell signal bar, they'll be disappointed with 72, and they may look to get out, break even somewhere in this area. I suspect probably buyers down here in at least a small bounce. And you can see what happened with 73. 73 retested the 71 low and ended up forming a bear bar, closing on its low. Tight trading range. We may still get a second leg down after this sell-off. Not ideal. And then we tried to get a reversal up on 74. Good for the bulls. Looks like we're going to try and go higher, maybe up to the moving average. And then we formed a bull bar 75, but found profit taking at the moving average in what could be a tight trading range. And then you can see we sold off in the final minutes of the day, forming a pretty clear bear breakout below the bear flag. Some traders will see it as just a large bear channel, so spike, pullback channel. Almost a leg one, leg two. Why did I pick the 18 low instead of the 7 low? Because on a higher time frame, this is just one large bear breakout. And so we pretty much got a leg one, pullback, leg two. For stop entries, okay to sell below 1, sell below 2, and then some bulls get out above, some bears get out above 8. I don't think they have to, and if they do, they probably sell again, maybe below 11 or 12. More bulls, more bears will exit above 19. Some bulls will buy, but I don't think it's really all that great of a buy, probably a minor reversal, and therefore bears will look to sell after a couple of legs up. What about selling below 25? Probably not, but selling below 29, a wedge top, 1, 2, 3. That's reasonable, and therefore bulls will probably exit below 29 as well. Bears that are short, where do they get out? Now, they might get out above 39, 3 pushes down here, here, and here, but a weak signal bar, and therefore when they see 40 get bad follow through or become a bad entry bar for the bulls, you'll have more and more bears start to sell, especially when they see a bear bar like 41. Bears that are short, they probably get out above 46 for sure. Bulls can buy 46, 47, 48, any of these bars, and they probably get out below any of these bars over here if they're smart. And then bears, maybe they sell as 65 is going down. I don't think they have to. And then as far as selling 66, I think it's really selling too low in the range. I think it's better to probably wait and see what the pullback looks like. And all through here, bad buys, bad sells, maybe buying above 74, but really late in the day. And that actually makes it more of a lower probability trade. And then I think it's really not practical for most traders to try and catch this. Typically by bar 72, usually it's better to do nothing for limit orders. Probably sellers above 3, buyers below maybe 6, but sellers on the close of 10. And then I thought probably sellers above 15. I thought buyers below 21, but I thought sellers above 20, scaling in higher. Probably buyers below 24, scaling in lower. I thought sellers above 30. We had a wedge top 1, 2, 3, and a bad high 1. I thought it was a high probability sell above 4, second leg down. And I thought buyers below 44, buyers below 45, buyers below 50. And it's probably it for limit orders. There's other trades, but I think those are probably the easier ones. Buy the close, sell the close. It's probably sell the close 2, sell the close 3, sell the close 4. And once you start getting overlap 3 and 4, it's better to sell pullbacks. And then when you see 6 and 7, instead of selling closes, usually it's better to wait for the reversal attempt, like 8 and 9, and look to sell the reversal. And then all through here, you're not great, sell the close, but probably sell the pullback. And then, as far as 25, 324, is that buy the close? Probably not. It's probably more buy the pullback. And then same thing with 32. Not a great sell the close, better to sell the pullback. Same thing, 42, not a good sell the close, better to sell the pullback. Then maybe 48, 49, 50, okay, buy the close. But once again, it's better to buy the first reversal attempt for a bounce. Then same thing, 65, 66, don't sell the close, look to sell the pullback. Let me take a look at questions. Okay, question, why would bar 70 be a bad buy? It's not a great buy because it has a lot of overlap. So it's a overlapping bar. It's an outside bar in the middle of a tight trading range after a strong bear breakout, 65, 66, and that lowers the probability for the bears because the bears, there's increased risk of a second leg. A question, with first bar on the open being a large bear, with first bar open large bear today, where it is difficult to take profit targets, how would you construct a profitable trade in the first 1 to 3 bars? But yeah, so whenever I see bars like 1 and 2, I typically expect 2 things. My expectation is you're probably going to get a measured move of bars 1 and 2. However, you're probably going to get at least a minor pullback before you get the measured move. So if you're selling the close of 2 and you have a stop above 1, you're probably going to have to hold through a deeper pullback than what you want, because most of the time the market doesn't just immediately sell off. And what I mean by that is this is pretty common. Bar 1, you'll have traders sell below it. It's sensible. But bar 2, I thought was a much higher probability sell. It's consecutive bear bars. And look what happened. The high of 1 to the close of 2. So it's reasonable if you sell the close of 2, put a stop above 1. And look at the target. Price came really close to it here and couldn't quite get there. And there's several reasons for that. One, the risk was big. There's a lot of overlap in here. And therefore, that overlap is a sign of trading range behavior. And trading ranges usually get retested. And therefore, when you got the bear breakout 6 followed through 7, there's increased risk that would pull back and test that. So for me, the way I think about it is I think about this as being something minor. And so if I'm selling on 6 or selling on 7, I have to mentally be prepared that while this is a spike in channel, spike, pullback, channels evolve into trading ranges. And therefore, even though the sell-off to 6 and 7 is a bear breakout on a higher time frame, it could still get a 30% pullback or 40% pullback based on this entire range. So what I'm saying is this. It's the market cycle in the current time frame. This right here is a spike, and this right here is a channel. So you have a bear breakout, pullback, channel, down, so maybe 1 leg, 2 legs, 3 legs, a test of the top of the trading range, the test of the start or top of the channel, and then the market ended up forming a bear flag and getting resumption. And so the way I think about it, and that's kind of a long-winded answer as to how would you structure the trade. For me, I think this, most importantly, this is strong enough for a second leg. And whenever I start to see 1, 2, 3, maybe 4 bars on this time frame going down, sometimes my preference is to, I think it's really helpful to look at a higher time frame, something like this. Here's the first 30 minutes of the session. So the first 6 bars, consecutive bear bars. And therefore, bar 6 is 9 o'clock, bar 2 on the 15 minutes, 9 o'clock. And so whenever I see that, it makes me, I like to think about a higher time frame and think, okay, we have consecutive bear bars on the open. That's strong enough that we're probably going to get a second leg down. And therefore, we could easily get a reversal bar. But if we do, it's probably a bad reversal, and it'll probably lead to sellers above. And you can actually see something pretty interesting with 915. So this is actually 915. And so this bar closing on its high, 9, is actually this reversal bar here. And what do you notice? What happened on the first 33% of this bar on the following bar? You can see that bar 10 actually went up and then down and then retested the close. So what does that tell you? That tells you over here the market went down and then back up, allowing traders to exit the trade. You don't see it on this time frame. You just see it as this bar reversing down. But the reality is it's not what happened. On this 15-minute bar here, this bear bar, the breakout pullback sell, so the 15-minute bar at 9:30, the market actually sold off on 9:15 here. Whoops. Sold off on 9:15, which is 9:20, which is bar 10. Sold off and rallied and then sold off again. And the point of me saying that is a lot of traders, when they see this kind of stuff, they'll be quick to exit and then re-enter again once they sense hesitation. But for me, my expectation would be a second leg down. And there's many different ways you can trade that. Okay, question bar 44, you said it was not a good location for bears to sell. We broke below a double top neckline by bar 42. And had a good close. Oh, okay. I see what you're asking. So let me rephrase that in my own words to make it easier. So basically, why did you say that bar 42 is a bad sell to close bar? We can't see these lines right here. So we'll just pretend they're not there. But basically, a couple thoughts. Whenever you have sell-off and a rally and lots of overlapping bars, and basically right here, we're saying it's a trading range. And then this one bar on this chart, bar 42. So without 42, it looks like a trading range. And this one bar, big bear bar 42, all of a sudden we're saying, yeah, it's a bear trend. But the problem is, this is a buy zone. Because if this is a channel, channels evolve into trading ranges. And therefore, look what's happened. Look what happened on this bar. Bulls that bought the sell-off were able to make money. Now, bulls, if they're buying the sell-off to 42, guess what? They're probably going to make money. And therefore, I call these reach trades. Traders don't buy, when they sense the market's in a channel, the buy zone's not breakout points. They don't buy the 39 low. They don't buy the 18 low. What they do is they buy the breakout of the 18 low. So they wait and see what the breakout looks like, and they exit. And so when they see a bar like this, their median expectation is strong enough that we may get a second leg or pause. But it's kind of like everyone's got their finger on the trigger waiting to buy. But they're not going to buy until they see at least hesitation. Because if the market does hesitate, we could rally for several bars. We sold off, rallied, retested the lows. Now we have a possible micro double bottom, sell to close bears getting out break even. And then you can see what happened. We tried to break to the upside and reversed, and we tried to break to the downside and reversed up. A lot of traders will start buying back shorts here. So my thought was this is not a good sell, because if you do sell down here, you got to be really quick to manage the trade. And so when you see that bull bar 43 and you see this bear bar 44, if you're smart, it's probably best to get out of your shorts and wait for the next trade, because you're selling what could be the start of a trading range. We could reverse all the way, back up to this high. In this case, we didn't, but you can see how high up we went. Actually, I say that we went really close to it. That was my overall thought. So where do we go tomorrow? Well, the bears have a chance to get follow through selling, so it'll be interesting to see what they can do on the daily chart. But overall, we have a strong bear bar that increases the chances that we may end up testing somewhere down here over the next couple of days. But I suspect today is strong enough that we probably won't get a strong bull reversal bar. Anything's possible, but I suspect probably something disappointing. Tomorrow's probably not going to be a strong bear bar, but I suspect something disappointing on the day. All right, thanks for watching, and hope everyone has a good day or good rest of their evening.